Okay, thank you for the kind introduction, Professor Brett, and also the organizer. Greeting from Jakarta, everyone. Our research is about financial institution tax aggressiveness. So basically, we have a unique corporate tax return data to evaluate the behavior of financial institutions in minimizing their tax. So we compare their tax burden with the firms operating in other sectors, and also we try to investigate what are the specific methods or techniques that they use to minimize their tax burden. So that's basically the overview. This study is done a part of my PhD journey at the UTS Business School with my supervisor Robert and my colleague Salim Darmadi. Okay, so basically this idea is quite simple. So whether other financial institutions are more tax aggressive in comparison to other sectors. So this is for us this is very interesting question because most of the studies exclude the financial institution because they are different in terms of the legal environment and also accounting standard. So basically, in the literature at the moment is very minimum findings or knowledge about the behavior of the financial institution in managing their tax burdens, and then we try to move on the specific question that to the specific method or technique that they use to minimize their tax burden. So basically, we try to identify whether they're using the costly methods like transfer pricing or tax haven or other method, or they try to use the less costly method like the differences between accounting standard and tax laws. So that's basically the two main ideas that we investigate in these studies. Okay, the backgrounds is basically because the main focus of the study currently on the financial institution is mostly on their economic roles in providing sufficient liquidity to the economy, like prudential and intermediary aspects. But the existing studies mostly um, try to exclude what the tax compliance behavior of these financial institutions. So we try to look at the area that mostly overlooked by existing studies in the financial institutions to whether because of their access to financial transaction and also their knowledge on financial arrangement, whether they're being more aggressive in managing their tax burden or they are not aggressive because they are well supervised and well regulated. Okay, so our sample came from the confidential tax return of financial institution operating in Indonesia mostly, and then also we have also other firms in other sectors as our control firms. Okay, the research questions is the motivating question is are financial firm tax aggressive amidst the stringent prudential regulation and supervision? And then the specific research question is are financial firms more tax aggressive relative to their peers operating other sectors, and what specific methods are used in minimizing the tax burden. Okay, so the data came from the Indonesian tax authorities. So basically, our study take almost all financial sectors operating in Indonesia, not only banks. So we also have some insurance company, financial securities company, stockbroker, and other financial institutions. This is basically the sample selections. We use quantitative approach. So basically, we try to choose the sample that are comparable with other quantitative studies. So the result could be generalizable. So we exclude some of the firms that have a abnormal condition, like they have a total ETR less than 0. I mean, they're making loss, or total ETR more than 1. We also include some small firms and also some other firms that are very different with the financial institutions. Okay, so this is the industry that we use in the study. So basically, the financial institution consists of mostly banking banks. We have 83 firms and 617 observations, and then we have broker dealer and financial securities companies. We also have insurance companies, equity financing like holding companies, and then also trust financing, and also stock exchange and settlements. So basically, in terms of sub-sector in the financial firms, we have a good variation of the subsector, I think, and we believe that the result also could be generalizable to the subsector within the financial industries. Okay, so in terms of methodology, the first we construct the measures of financial firms tax burden. So basically, in Indonesia, some of the financial firms' income is subject to final tax, and the other types is subject to the comprehensive corporate income tax in the end of the fiscal year. So basically, we combine these two type of taxing systems. So we add the corporate income tax paid and also the final income tax paid. So basically, with these measures, we can capture the total tax burden paid by this financial institution. Okay, so we create the annual measure, and also in the sensitivity study, we create the aggregate 3 years and also 5 years to evaluate the consistency of the initial finding. Okay, and then now this is the method or techniques that we can identify from the tax return data that it may be used by the financial firms to minimize their tax burdens. So first we have the treaty shopping. This is basically the total transaction with their affiliate in the treaty partner countries with Indonesia. So basically we try to capture whether they use the tax treaty improperly. So they use the tax treaty basically to shift the transaction to enjoy the lower tax rate or tax benefit provided by the tax treaties. We also have the leverage, whether they use the capitalization to minimize the tax. We have tax shelter, basically it takes from Wilson 2009, the shelter index. We have temporary book tax difference and also permanent book tax difference. Conforming tax avoidance, this is the new measure proposed by Badesters in 2019. And then we have loss, fiscal loss, also tax haven, and then non-routine transfer pricing. The last measure, the last proxy basically capture the non-routine transaction done by the affiliate. And then I think we can skip this hypothesis. The method, the main estimation method, we use the different and difference approach. So basically, we create the dummy variable called fin. This is the finance basically. So if they operate in the financial sector, they get 1, and if they don't operate in the financial sector, they get 0. So basically, the operating in the financial sector is the treatment that we want to evaluate whether this is affect their tax burden. Okay, so the control group will be the financial sectors that I have previously explained, and then the treatment group is the financial sector, and the control group is the other sector which operate in the other sector other than the financial sector. Okay, so we found a quite convincing finding that the financial sectors basically have a lower tax burden compared to other sectors. So if you look at the coefficient of fin is very significant at 1% level. So basically we can see from this that in average the financial firms is paying lower tax burden around 0.065% annually. So basically they can we can infer from this finding that they actually can use the complex financial transaction or their knowledge in the financial institution to minimize the tax burden. And the next one is how we evaluate what are the methods that they use or the technique that they use to minimize the tax burden. So basically we regress the 9 methods that we can identify from the tax return data to their tax burden, and also we control from the subsector and year fixed effect. We found that the financial institution basically tend to use the most sophisticated method. So they tend to use this tax shelter to minimize the tax burden. So they use the method that really difficult to be found by the tax authorities. And also in the same time, they also use the most simple method like book tax difference, temporary or permanent book tax difference. So they combine the most sophisticated tax avoidance method with the most less costly method like a book tax difference. Like they might choose the accelerated depreciation for tax, and also they also combine it with the tax shelter operating in tax haven countries. So I think the finding is quite interesting for us, and then it also have a good policy implication for the government. Okay, and then to calibrate the findings, we do a lot of sensitivity studies to just to make sure that the finding is valid, and then we use the alternative measure of tax burden with 3 years and 5 years average. We found consistent findings. We use quantile regressions and also fixed effects models, and we also try to introduce whether the foreign-owned financial firms are different than the domestic-owned financial institution. We found that foreign-owned financial institution is less aggressive compared to domestic financial institution. It may infer that maybe try to providing some room for foreign investors come into the financial institution will be a good idea to lower the tax aggressiveness behavior. That's another interesting finding. And also lastly, we use the propensity score matching to find a proper control group to validate the findings. Okay, so the conclusion is the financial firms have reduced tax burdens compared to other firms operating in other sectors, suggesting that financial firms exploit the opportunities of tax avoidance using the complex financial transaction or other method that not available for in other industries. And then they use tax shelters as the most sophisticated tax avoidance method in combination with less costly tax avoidance method like temporary differences and permanent differences between accounting standard and tax law. I think this is quite a unique behavior that the government, the tax authorities, and also the financial sector authorities should consider this behavior when they evaluate the viability of so it is only evaluate the viability of the firms to operate, like they evaluate the capital adequacy ratio or they evaluate the non-performing loan, but mostly they overlook the tax compliant behavior of these firms. So I think in the future there should be a good coordination between tax authorities and financial authorities to mitigate any risk of bankruptcy or risk of financial crisis because of the behavior of the financial firms. Okay, that's pretty much all. Thank you, everyone. I'm happy to receive your question or comment.